Picture this. You flip on the news and the anchor's voice drops into that serious tone reserved for only the biggest stories. The headline behind her reads, "Oil shock, the day energy prices broke." Gas station lines stretch around the block. Airline apps crash from people trying to check their fares before another increase hits. Truck drivers pull into weigh stations and stare at diesel pumps ticking past numbers they haven't seen in years. Central bankers cancel weekend plans for emergency calls. And halfway around the world, a narrow strip of water barely 20 miles wide has just rewritten the global economy overnight. That strip of water is the Strait of Hormuz, and in early 2026, it became the epicenter of one of the sharpest energy shocks in modern history. Roughly a fifth of all the oil and a fifth of all the liquefied natural gas the entire planet consumes passes through that single choke point every single day. When military strikes between the United States, Israel, and Iran erupted at the end of February, Iranian forces didn't just threaten the strait, they attacked it directly, launching drones and missiles at tankers, laying mines in shipping lanes, and declaring the waterway closed to commercial traffic. Within days, insurance companies that cover cargo ships pulled their coverage or jacked up premiums 4 and 5 times higher than normal. Crews refused to sail into a war zone. Shipping firms suspended operations entirely. For all practical purposes, one of the most important arteries in the global economy had gone silent, and the price of oil didn't just rise, it exploded. Brent crude, sitting calmly around $70 a barrel in late February, rocketed past $100 within 2 weeks and kept climbing toward $118 as the conflict dragged on. Economists at regional Federal Reserve banks ran models suggesting that if the closure lasted long enough, prices could eventually test $130 a barrel before any relief arrived. This is the part of the story most people never see on the news, the quiet, cascading chain reaction that turns a distant geopolitical flashpoint into something that empties out your wallet. Meet Michael, a 42-year-old logistics manager who runs dispatch for a mid-sized freight company out of a warehouse just outside Chicago. On a normal Tuesday morning, Michael's biggest concern is making sure 200 trucks leave on schedule. But this particular Tuesday, his phone buzzes with an alert from his fuel supplier. Diesel prices are jumping again, the third increase in 2 weeks. He pulls up the numbers and feels his stomach tighten. Diesel that was sitting around $3.75 a gallon has climbed past $5.60, an increase of more than 50% in a matter of weeks. For a company that burns through tens of thousands of gallons a month, that's not a rounding error. That's an existential threat to the bottom line. Michael isn't alone. Every trucking company, every shipping line, every airline on the planet is running the same math in a panic. Airlines are getting hit especially hard because jet fuel typically eats up somewhere between 25 and 40% of an airline's total operating costs. And when crude prices spike that fast, that share can jump past 45% almost overnight. Within weeks, airlines around the world start rolling out fuel surcharges. Cathay Pacific hikes its short and long-haul surcharges twice in 2 weeks. Air France and KLM raise long-haul fares, citing the sudden spike in kerosene costs directly in their public statements. Qantas adjusts fares route by route. Scandinavian Airlines cancels nearly 1,000 flights in a single month because the math on certain routes simply stops working. Indigo, one of the largest airlines in India, adds a surcharge that in some cases multiplies by more than 5 times its previous level. Passengers booking flights to Dubai, Bangkok, or London suddenly find themselves paying noticeably more than they would have just a month earlier. And airline executives openly admit they have 3 choices: raise fares, cut flights, or both. Back in Chicago, Michael's phone keeps buzzing. His fuel supplier isn't the only one raising prices. His customers, the grocery chains, the retailers, the manufacturers who depend on his trucks, start feeling the squeeze too, because every gallon of diesel that costs more eventually gets baked into the price of everything those trucks are carrying. Grocery stores quietly raise shelf prices to cover higher transportation costs. Retailers add small increases across entire product lines. Manufacturers, watching their input costs climb, pass a portion of that pain down the supply chain until it lands, as it always does, on the household budget. And the data backs this up in ways that are impossible to ignore. In the United States, the Consumer Price Index, the most closely watched measure of inflation, jumps from 2.4% in February to 3.3% in March, then keeps climbing to 3.8% by April, the highest reading in nearly 3 years. Average gasoline prices at the pump climb from around $3.14 a gallon to $4.50 in a matter of weeks, an increase of roughly 40%. Airline fares alone rise more than 20% over the year, according to government inflation data. Economists at major banks scramble to update their forecasts, warning that if oil prices settle anywhere near $100 a barrel and stay there, every $10 increase in crude translates into roughly 30 cents more per gallon at the pump, which adds up fast when the increase is $40 instead of $10. The Federal Reserve finds itself in an uncomfortable position, watching inflation numbers climb while trying to decide whether raising interest rates to fight that inflation might choke off economic growth that's already fragile. Central bank officials describe themselves publicly as needing to stay nimble, acknowledging that inflation sits well above the comfort level of both consumers and policymakers, without being sure yet whether the spike is temporary or the start of something longer lasting. Governments don't just sit back and watch either. Within days of the closure, the United States announces one of the largest emergency oil releases in its history, pulling 172 million barrels out of the Strategic Petroleum Reserve. The International Energy Agency coordinates an even larger response, organizing its 32 member nations to release 400 million barrels combined onto the global market in an attempt to soften the blow. But here's the uncomfortable truth that energy analysts keep repeating during every one of these crises. Releasing emergency reserves is a bit like trying to put out a forest fire with a garden hose. The United States alone consumes roughly 20 million barrels of oil every single day. So even an aggressive release covers only a few weeks' worth of national demand once you spread it across the entire market. It slows the bleeding, it doesn't stop it. Prices keep climbing for weeks despite the releases, offering only modest, temporary relief rather than any kind of real solution. The choke point crisis doesn't stop at oil either, because roughly a fifth of the entire planet's liquefied natural gas supply also moves through that same narrow strait. And when a major Gulf energy hub took direct hits during the fighting, the operator was forced to declare force majeure on its shipments, freezing deliveries that utilities and industrial buyers around the world were counting on. Natural gas prices wobble upward in response. And while the impact stays more contained than the oil shock, it adds another layer of pressure onto electricity bills and industrial energy costs in the months that follow, especially in regions already dealing with colder than average winters. Shipping companies scramble to find workarounds that have nothing to do with oil prices directly, but everything to do with the same underlying disruption. Some Gulf producers start rerouting crude through overland pipelines toward the Red Sea coast instead of risking the strait entirely, but that alternative route runs at a fraction of its normal capacity and adds days, sometimes weeks, onto delivery timelines. Air cargo carriers suspend routes as regional airspace closures ripple outward from the conflict zone, and container ports across the Middle East back up with vessels that diverted away from the danger zone and now have nowhere efficient to go. For companies like Michael's that rely on imported components, not just fuel, this means a second wave of cost pressure arrives just as the first wave, higher diesel prices, is still working its way through this business. Meanwhile, economists poring over historical data start asking an old question with fresh urgency. Does oil really drive food prices the way people assume it does? Long-running government data tracking, global food costs alongside crude oil prices going back decades, shows the two do tend to move together over long stretches of time. Energy costs feed into everything from fertilizer production to tractor fuel to the diesel that powers the refrigerated trucks carrying produce across the country. So when oil spikes hard enough and stays elevated long enough, grocery bills eventually follow, even if the connection takes a few months to fully show up on store shelves. Not every part of the world feels this shock the same way either, and that unevenness matters enormously for how the story eventually resolves. China, once the single biggest engine of rising global oil demand, barely blinks during the crisis, because the country has already been rapidly electrifying its passenger vehicle fleet for years, with electric vehicles accounting for more than 40% of new car sales there even before the conflict began. India tells a completely different story. Its oil consumption keeps climbing steadily as industrial expansion and a fast-growing middle class push more vehicles onto the road every year, meaning India increasingly becomes the market that determines whether global oil demand keeps rising or finally starts to plateau. This divergence, one giant economy already moving past oil while another giant economy is still climbing the same curve the West climbed decades ago, quietly shapes how OPEC and non-OPEC producers alike think about the next 5 to 10 years of planning, regardless of where prices happen to sit in any given month. Back at Michael's warehouse, the pressure keeps mounting. His executive team calls an emergency meeting. Fuel costs have become the single largest threat to the company's margins, bigger than labor costs, bigger than insurance, bigger than anything else on the balance sheet. They're faced with the same brutal choice airlines are making: raise prices on customers, cut costs somewhere else, or find a fundamentally different way to operate. Not far from Michael's warehouse, a family named the Alvarez household is running its own version of this math around the kitchen table. Elena Alvarez and her husband had been planning a summer vacation for months, flights already bookmarked, hotel rooms half chosen, and then airfare prices climbed more than 20% in a matter of weeks, while their grocery bill quietly creeps up right alongside it. They don't panic, but they do what millions of households quietly do during every energy shock: they start trimming. The vacation gets postponed to the following year. Dinners out become less frequent. A planned kitchen renovation gets pushed back another season. None of these decisions show up as a single dramatic headline, but multiplied across tens of millions of households doing the exact same quiet math at the exact same time, they add up to a measurable slowdown in consumer spending that shows up in retail sales reports within a single quarter. Economists watching this unfold describe it as one of the most predictable patterns in the entire playbook of an oil shock. Energy costs eat into discretionary income first, and discretionary income is precisely the category that airlines, restaurants, and retailers depend on most for growth. This is where the story usually splits into two very different paths, and both are happening at once across the global economy. The first path is simple short-term survival. Businesses pass costs down the chain, consumers cut back on non-essential spending, families postpone vacations, delay big purchases, and eat out less. Exactly the kind of pullback that shows up in retail sales data during every oil shock in modern history. The second path is more interesting, because it's the one that actually reshapes economies over the following years, not just months. Michael's company decides not to just absorb the pain and wait for prices to fall back down. Instead, they lean into something they had been considering for over a year but never had urgent enough reason to fully commit to, overhauling their fleet with artificial intelligence, powered route optimization, and shifting a portion of their trucks toward more fuel-efficient and electric alternatives. This isn't some hypothetical future technology. It's already happening at scale across the trucking industry in 2026. Case studies from fleets around the country show that AI-driven route planning, combined with driver behavior coaching, can cut fuel consumption by more than 20% within a single year. One mid-sized fleet in Nashville with under 200 vehicles documented a 22% drop in fuel use over 12 months, saving more than $400,000 annually just from smarter routing, reduced idling, and coaching drivers to avoid aggressive acceleration and unnecessary high-speed driving. Industry surveys find that roughly 40% of fleets using AI for route optimization report savings of up to 50% on fuel costs and operational expenses combined. The math is almost absurdly simple once you see it. Fuel typically represents somewhere between 24 and 40% of a trucking company's total operating costs, so even a modest 10 or 15% reduction in fuel use translates into tens of thousands of dollars in savings every single year. And for larger fleets, it can mean millions. Michael's company installs telematics across its trucks, feeds live traffic data, weather conditions, and delivery windows into an AI system that recalculates optimal routes in real time, and starts matching outbound deliveries with return trips instead of sending trucks back empty, eliminating what the industry bluntly calls dead miles, miles that cost full fuel price while generating zero revenue. Within months, fuel consumption across the fleet drops meaningfully, and suddenly the same oil shock that nearly broke the company becomes the exact pressure that forced it to become more efficient and more resilient than its competitors who chose to simply wait out the storm. Michael's story mirrors something much bigger happening across the entire global economy in real time. As fuel prices spike, drivers everywhere start doing the same math Michael's executives did, and the math increasingly favors going electric. According to the International Energy Agency's Global EV Outlook released in 2026, worldwide electric car sales are expected to surpass 23 million units for the year, pushing electric vehicles close to 30% of all new car sales globally, a genuinely historic milestone. What's fascinating is how directly this connects to the oil shock itself. Sales had actually dipped 8% in the first quarter of the year after some countries scaled back EV incentives, but the moment oil prices spiked past $100 a barrel in March, something shifted. Nearly 90 countries saw a jump in EV sales, with 30 of them setting all-time monthly sales records. Asia-Pacific markets outside of China saw sales surge 80% year over year. Latin America saw a 75% jump. Europe posted growth near 30%, with more than 1 in 5 new cars registered in the European Union during April being fully electric, up sharply from the year before. The reasoning is refreshingly simple. And it's the same reasoning that pushed Michael's company toward AI routing. When the cost of the old way of doing things spikes hard enough, the cost of switching to something new suddenly looks a lot more reasonable by comparison. Electric vehicles, according to the agency's analysis, deliver fuel cost savings that run about 35% higher when oil prices sit around $100 a barrel compared to more normal pricing environments, meaning the financial case for switching gets stronger exactly when consumers feel the most pain at the pump. Some analysts and futurists watching this unfold went so far as to call the spring of 2026 a genuine tipping point for the electric vehicle transition, projecting that the combination of collapsing battery prices, doubled driving range compared to a decade earlier, and this sudden fuel price shock could push electric vehicle and hybrid market share from roughly a quarter of global sales toward 80% within just a few years. Whether that specific timeline proves accurate or overly optimistic, the underlying pattern is hard to dispute. Oil price shocks accelerate the shift toward alternatives every single time they happen because they force millions of individual decisions, from a Chicago logistics manager rerouting his fleet to a commuter in Bangkok trading in a scooter, that all point in the same direction simultaneously. Wall Street's biggest banks spend the crisis rewriting their forecasts almost weekly, a reminder of just how quickly professional predictions can flip in an energy shock. Investment banks that had penciled in Brent crude comfortably in the $60 to $65 range only months earlier suddenly find themselves publishing notes acknowledging the market had blown past every assumption in their models, while central bank officials at the same time model out scenarios where a prolonged closure could add multiple percentage points of drag onto quarterly economic growth if it dragged on for 2 or 3 quarters instead of resolving quickly. Investors watching all of this pour money into anything that looks like insurance against future energy volatility, and renewable energy investment follows a similar logic. When fossil fuel costs spike and stay elevated, solar power, wind power, battery storage, and even nuclear and geothermal energy suddenly look far more attractive to investors and utility companies planning decades into the future, because the fuel cost for those technologies doesn't move with geopolitical tensions in the Middle East. It's effectively free once the infrastructure is built. Now here's where the story takes an unexpected turn, because energy markets rarely move in a straight line for long. While consumers and businesses were bracing for permanently higher prices, the underlying dynamics of global oil supply were quietly working against that outcome. Major producers outside the OPEC alliance, especially the United States, Brazil, and Guyana, kept pumping oil at record levels throughout the crisis, adding barrels to the market at a pace that shocked even seasoned analysts. Once diplomatic pressure eventually cooled tensions and a ceasefire took hold, the Strait of Hormuz gradually reopened to shipping, and the emergency premium that had been baked into oil prices started evaporating almost as quickly as it had appeared. Then came the twist nobody was fully prepared for. Instead of prices settling back to their pre-crisis levels and holding steady, OPEC and its allied producers, led by Saudi Arabia, made a strategic decision to unwind years of voluntary production cuts and start pumping more oil, not less. Saudi Arabia's own crude production climbed back above 7 million barrels per day, while American production remained near record highs above 13 million barrels per day. The reasoning behind this pivot reveals something important about how OPEC actually operates in the modern era. It isn't simply trying to keep prices high anymore, it's fighting to defend market share against a wave of new non-OPEC supply that shows no sign of slowing down. Every barrel OPEC holds back through production cuts is essentially a gift to competitors in Texas, the Permian Basin, offshore Brazil, and Guyana's booming new oil fields. So the alliance made a calculated bet that flooding the market now, even at the cost of lower prices in the short term, positions its members better for the years ahead. The result was almost the exact opposite of the dramatic headline we opened with. By the middle of 2026, Brent crude had drifted all the way down into the low 60s, and some forecasts from major investment banks even suggested prices could test the $55 range in the following year as a supply glut took hold. Analysts at major financial institutions warned that the world could see an oversupply of oil measured in millions of barrels per day, an amount so large it would require even deeper voluntary cuts just to prevent storage tanks from overflowing. This is the part of the story that rarely makes it into dramatic news segments, because a supply glut and falling prices don't generate the same kind of urgent breaking news energy that a shortage does, even though the economic consequences are just as significant. For oil exporting nations like Saudi Arabia, this reversal creates a genuinely difficult balancing act. The International Monetary Fund estimates Saudi Arabia needs oil prices somewhere around $70 to $75 a barrel just to balance its government budget, given the enormous spending commitments tied to its Vision 2030 economic transformation plan, an ambitious effort to build new cities, tourism destinations, and technology hubs that reduce the country's dependence on oil revenue over the long run. When prices fall well below that break-even point, as they did by mid-2026, it squeezes the very budget that's supposed to fund the transition away from oil dependence in the first place, forcing difficult trade-offs between short-term fiscal discipline and long-term diversification goals. And yet, remarkably, Gulf nations pressed ahead anyway. Saudi Arabia approved a budget exceeding $350 billion for the year despite the weaker pricing environment, explicitly choosing to accept a larger deficit rather than slow down its diversification agenda. Sovereign wealth funds across the region, including Saudi Arabia's Public Investment Fund, Abu Dhabi's Investment Authority, and Qatar's Investment Authority, collectively manage trillions of dollars in assets built up over decades of oil revenue. And these funds have become the primary vehicle for converting today's energy wealth into tomorrow's diversified post-oil economy, funding everything from renewable energy projects to technology investments to entirely new cities built from scratch in the desert. It's a fascinating irony sitting at the center of this entire story. The same oil wealth that critics say these nations need to escape is precisely the tool being used to fund that escape. Meanwhile, back in Chicago, Michael's company finds itself in an unusual position by the second half of the year. Diesel prices have fallen back from their crisis peak as the supply glut takes hold, easing some of the immediate financial pressure. But the investments the company made during the worst of the crisis, the AI routing systems, the more fuel-efficient vehicles, the smarter scheduling that eliminated empty return trips, don't stop paying off just because prices came back down. If anything, those changes make the company more profitable now than it was before the crisis ever began, because the efficiency gains stack directly on top of lower fuel prices rather than disappearing along with the emergency that originally inspired them. Michael realizes something that echoes across nearly every energy shock in modern economic history. Whether prices spike or crash, whether the crisis lasts for months or fades within weeks, the businesses, households, and governments that treat the disruption as a wake-up call, rather than just a temporary inconvenience, tend to come out the other side stronger, more efficient, and less vulnerable to the next shock, whenever and wherever it happens to strike. This pattern isn't unique to 2026 either. Economists studying the historical relationship between oil prices and broader inflation increasingly argue that oil no longer carries the same outsized power over the economy that it did during the oil shocks of the 1970s. Back then, rising oil prices were arguably more a symptom of deeper structural inflation problems than the root cause of them, and today's economy, with its more diversified energy mix, more flexible labor markets, and more sophisticated central bank tools, tends to absorb and unwind oil price shocks faster than it once did, even when the initial spike feels just as dramatic on the evening news. That doesn't mean oil prices don't matter. Clearly, they still move inflation, consumer spending, airline fares, and grocery bills in very real and immediate ways, as anyone who filled up their tank or booked a flight during the spring of 2026 can attest. It simply means the relationship has become more complicated, more temporary, and more dependent on how quickly alternative energy sources, efficiency technologies, and smarter logistics can step in and absorb the shock. So, what's the actual lesson buried inside this entire chain of events? From a narrow strait in the Persian Gulf all the way to a dispatch office outside Chicago and a sovereign wealth fund managing trillions of dollars in the Gulf. It's that energy markets, more than almost any other part of the global economy, force rapid, visible adaptation precisely because the pain of not adapting shows up so quickly and so directly in everyday life, at the gas pump, on the airline boarding pass, on the grocery receipt. When oil prices spike, businesses and households don't just complain about it, they change behavior almost immediately. Accelerating investment in electric vehicles, artificial intelligence-powered efficiency tools, renewable energy infrastructure, and smarter logistics networks that outlast the crisis that inspired them. When oil prices later crash under the weight of a supply glut, the same forces play out in reverse for producing nations, forcing sovereign wealth funds, government budgets, and national development plans to defend diversification strategies, even when the underlying commodity that funds them becomes suddenly less lucrative. Neither high prices nor low prices are permanent, and neither one, on their own, determines the future of the global economy. What actually determines that future is how quickly people like Michael, companies large and small, national governments, and entire industries respond to the signal that energy prices are sending in any given moment. The evening news headline that opened this story, "Cheap energy is over, energy prices are surging," turned out to be only half true and only for a few short months. But the deeper story underneath it, the one about resilience, efficiency, diversification, and the relentless human instinct to adapt when the cost of standing still becomes too painful to ignore, that part of the story never really ends. It just keeps repeating itself with new headlines, new choke points, new commodities, and new versions of Michael sitting in a dispatch office somewhere, staring at a fuel price alert, and deciding whether to simply absorb the pain or use it as the push they needed to finally change how they operate for good. Zoom out far enough, and this single strait of water becomes a kind of case study for how modern economies actually work under pressure, not the smooth, predictable machine textbooks sometimes describe, but something closer to a living system that flinches, overcorrects, and eventually rebalances every single time a shock hits one of its most sensitive pressure points. Oil remains one of the most sensitive pressure points precisely because it touches almost everything at once: transportation, food production, manufacturing, heating, and the cost of simply getting a package from a warehouse to a front door. A shock that starts as a military conflict thousands of miles away ends up reshaping a family's summer vacation plans, a trucking company's entire technology strategy, and a sovereign wealth fund's decade-long investment roadmap, all within the same 6-month window. And just as quickly as the crisis arrived, the market's own internal logic worked to unwind it. Non-OPEC producers kept pumping. Alternative shipping routes opened up, however imperfectly. Diplomacy eventually cooled the conflict, and OPEC itself chose market share over price defense once the emergency passed, setting prices tumbling in the opposite direction, almost as dramatically as they had spiked months earlier. Few people watching the evening news in March expected that by summer the conversation would flip entirely from fears of permanently expensive energy to warnings about an oversupplied market and crude sliding toward multi-year lows. That whiplash, from shortage to surplus in a matter of months, might be the single most important takeaway of the entire episode. It's a reminder that betting everything on any one prediction about where energy prices are headed, whether that prediction says prices will stay high forever or stay low forever, has historically been a losing bet, because the same forces that push prices in one direction almost always plant the seeds of the correction that eventually pushes them back the other way. The businesses and households that build in flexibility, whether that means a more efficient vehicle fleet, a diversified national economy, or simply a household budget with a little breathing room built in, end up weathering both directions of that whiplash far better than anyone betting the future on a single number holding steady forever.